The world is, continues to drown in too much debt, and by virtue of that fact, we need to keep rates very low for a long period because the serviceability of those debt burdens requires a low term structure. So, as much as people get very excited about the normalisation of interest rates, they fail to think through the second and third derivative implications, which of course are tremendous amount of defaults in the system, and that would put a real crimp on economic growth. Yeah, to some degree, certainly. I mean, the corporate debt burdens have been growing tremendously. I mean, out of the world's biggest debt bubble being the GFC, we've blown that bubble substantially larger, about $90 trillion larger as a global complex. And we've hit that point in the cycle where corporate earnings are now under pressure, and we're seeing that through EBITDA numbers, even in this US reporting season, which is coming in better than we expected, although expectations were very low. But if we look at that period over period, those earnings are still in decay, but they have a huge debt burden that they now need to service, and of course that's causing indigestion in parts of the high yield complex. That's been most evident in energy. I think the rally back in oil is most welcome because a lot of that debt needs to refinance later this year and early next year, and would be much easier to achieve that if we have a more sustainable kind of mid-range oil price, which looks like we're experiencing at the moment. Look, we don't. We've written about this extensively over the last few months. We feel that the Federal Reserve are really in quite a difficult corner. And you've seen that by Yellen's testimony through the March Federal Reserve meeting, which was extremely dovish or supportive of much lower interest rates. Interestingly, since February 1994, which was a very famous year and month for bond investors when Greenspan unexpectedly hiked, we've had a forward statement from the Federal Reserve, and we've had 126 Fed meetings since that date. In all 126 of those Fed meetings, the Federal Reserve have never adjusted interest rate policy unless the Fed funds futures market has priced that move ahead of time. Now, that's not to say that the Fed funds market can't move late, a few days before, but the Fed clearly wants the green light from the market that it's ready. At the moment, looking at those probabilities, we're around 18% for June, so almost very low probability, and still sub 50 in the mid 40s for December. I guess the market's expectation is the Fed won't be operating through the presidential cycle. They tend to not operate in that window. So at the moment, June or December look like the two likely spots that they could, although we feel that June is not likely, as much as the commentary will have to soften because equity markets have had such a great rally. We're now in the 8th week of our equity move higher in what has been, I guess, quite a investable rally if you're a big policy follower. I don't think the fundamentals have changed a tremendous amount, but the sentiment around that fundamental has changed tremendously by virtue of the soothing words of Yellen in particular. So it'll be interesting to see what that narrative from the Fed looks like going forward, because risk markets have done a lot better, credit spreads have come in a little bit, certainly financial conditions have eased somewhat, and the US dollar's rolled over and cooled a little bit too, which helps the whole complex.